Hey, what's up, everybody? It's Steve from the Zon team with another market update. It is October 1st. We just got the September numbers in, and I'm going to take you through the whole thing and exactly what happened in September. Also, I want to take you through a buying planner to show you the numbers of why potentially now is a good time to buy for you, depending on your circumstance. And then we're also going to talk about inflation, bond yields, and interest rates and how they all tie together. And lastly, I want to show you some interesting trends that are likely to unfold as they typically do in this type of year. Okay, so we're going to first begin with the mortgage rates, mortgage interest, and all that fun stuff. So let me pull it up and kind of take you through this. And I'm going to be going through this a little bit slower because there's a lot to cover. So feel free to run the video at 2 times speed if you feel like you need to speed it up at all. Okay, so first thing I want to cover is that back on September 7th, we had the Bank of Canada raise the interest rates 75 basis points to 3.25%. So that just happened on September 7th. So immediately, if you had a variable rate mortgage, your mortgage went up right away 75 basis points. So anytime the Bank of Canada raises interest rates, their overnight lending rate, the banks want a spread on top of that. So for example, if the Bank of Canada offered a 1% lending rate, banks want a 2% spread profit essentially over and above that rate. They're going to charge you 3% on a variable interest rate. Sure, some offer discounts and stuff, but that's getting a little bit more complicated. And if you're looking for a mortgage, we can talk about that later. But that's essentially how the variable mortgage rate market works, where the fixed market rate works on bond yields. So if you actually are on a fixed, looking for a fixed mortgage rate, if the bond yield market goes down, so will your potential options for fixed mortgage rates. As you can see here, back in September 19th, when we shot the last video here, we were currently at 3.386% on the bond yields, and we're currently at 3.349. So what does that matter? Well, as you can see on this chart here, since we did the last update, the fixed mortgage rate actually dropped 10 basis points. So variable interest rates are going up, but the fixed rates are coming down. I know it might seem a little bit crazy and complicated. So if you do need some expert advice, feel free to reach out to us. We'll get you connected with an amazing mortgage partner. One of our mortgage partners here is Frank Mortgages. And while we're on the topic of Frank Mortgages right now, they're offering the Zon team customers cashback incentives for their products. So if you're interested in getting some cash back when you do a mortgage, Frank Mortgages will have you covered. Okay, so that's currently what's going on with the fixed mortgage rate market. And the question we have to ask ourselves is, so why are these interest rates going up like crazy? So I'm sure you've probably heard of inflation in the last little while. And I'm just going to pull up the historical inflation data that we currently have here. So we can currently see that August is at a 7% inflation rate, where back in June, we were at 8.1%. So good news is the inflation is starting to trend down. And if it continues to trend down, the Bank of Canada is likely going to be less pressured to raise interest rates. And you might ask yourself, well, why are they raising interest rates to fight inflation? Well, right now there's an issue with supply chains and still getting supply to the marketplace. And if purchasers have too much purchasing power, they're essentially bidding up the price of these goods. I know this might be an oversimplification, but it is a pretty generalistic explanation of what's happening. So consumers have a lot of purchasing power. Supply chains are not getting fixed. We can't get supplies in. So therefore, the cost of these supplies and these goods is going up. So one of the levers the Bank of Canada has to play with here, if we can't fix supply, well, then we have to kill demand. So how do you kill demand? Reduce the purchasing power of the consumer. And once they do that, they're essentially using the interest rate lever to essentially make debt more expensive. So your lines of credits, your credit cards, your house mortgage, all that fun stuff, your home equity line of credits. So the more expensive things are, we might second guess or hesitate to buy that thing that we were thinking about purchasing, therefore slowing down demand. Hopefully that was a good explanation for you about why it's happening the way it is. So all you need to know currently right now is that inflation is coming down and we're all set on that trend. So hopefully that trend continues. Okay, so next thing that we want to talk about here is that's essentially what's happening with the mortgage rates, inflation. And obviously, if you've watched these videos in the past, you'll have seen that it has an effect on the real estate market. Okay, so let's jump into the real estate market and see what's currently happening. And before I jump into everything here, I want to kind of show you a trend that usually plays out at this time of the year. So currently, if I go to the comparison report here, you'll see above, sorry if you hear any kids, I have some kids at home right now. If you see above, backs and since 2017, 2018, and I'm going to go through all these charts, you're going to see a very similar trend. Starting in October, outflow exceeds inflow by a wide margin. So what does that mean? Well, currently we have a certain amount of inventory on the market, and the last 3 months of the year is when inventory starts falling off. And if inventory starts falling off, but demand stays consistent, then prices are likely going to go up. It's a supply and demand issue. So here we see that here's the outflow. So demand is well above inflow, which is supply. And that's true for 2017. That's true for 2018. That's true for 2019. That's true for 2021. And again, here in 2022, we're about to enter that phase. However, we've actually had 2 previous months, August and September, that both had more outflow than inflow. So what does that mean? Well, it kind of already is starting to play out where the market is correcting itself a little bit. There's less supply, and there's seems to be a decent amount of demand still in the marketplace, which is now stabilizing prices. I can show you what I mean by going over here to the monthly average sale price. So I want to talk to you about this for a reason, and I've been drawing comparisons to 2017 for essentially the entire year, and maybe even a little bit last year as well. As you can see here, in April of 2017, we peaked out at the marketplace, and we essentially went through 4 months of correction, and then we went in September, we went green. Here we are in 2022, we peaked out in April, and then we essentially had 4 months of correction again. And lo and behold, in September, we have an increase again of 2.51%. So the difference between 2017 and 2022, obviously the circumstances were different, but the outcomes are looking to be the same. So what happened in 2017, the real estate market stayed flat for a year thereafter. Essentially, it was just going, it was just weaving pretty much flat for a whole year. And it took essentially 34 months for the market to recover its average sale price. So if you see in April, and then here in February of 2020, we can see that that's the first month that the average sale price was higher than in 2017. So why am I telling you this? Why does this even matter? Well, if you're waiting for the bottom of the market, so there's a couple of things I want to tie together here. If you're waiting for the bottom of the market, we might have found it potentially right now. So the reason I say that is because, well, in April we peaked, and then we had the inflation rates here in April in 2022 hit up to 6.8%, and we saw that there was every single month inflation was increasing, and this is really where the Bank of Canada started hitting us with big interest rate hikes. So that's the disruptor. They introduced a disruptor into the market. Back in 2017, they also introduced a disruptor. They increased the lending rate, the qualification rate, and they did an increased rate on foreign buyers tax. So they introduced a disruptor in 2017, and they introduced a disruptor in 2022 now. So typically in a real estate market, it takes 4 months of normalization. So essentially the disruptor happens, it takes 4 months for the market to be like, oh my gosh, is the world falling apart? And then after 4 months of figuring it out, you exit the old market and enter the new market. So that's played out in 2017, and it looks like it's playing out now. The reason I say that is because inflation over the last 3 months, so peaked in June, 7.67. So hopefully the interest rate hikes that the government has been implementing is having the desired effect that they want. And if it's going to give the desired effect, the Bank of Canada might chill out a little bit and stop raising interest rates. And if they stop raising interest rates and the market has found its new normal, and then now that could signal the bottom of the market, and we can essentially see a rebound. So I'm looking at all these factors, and I'm thinking, hey, this market played out exactly the same way in 2017. Here we are with an increase again from 2.51%. So it's not like the market's rocketing and getting away from anybody, but it's potentially the right time to buy because there's some signals in the market that indicate that inflation comes down, and the prices in the real estate market have come down enough where the supply is meeting the demand. We can essentially have that bottom where purchasing might make the most sense. And I do have that buyer planner that will go over to show you the difference between what it was like buying over here and what it's like buying right here. Okay, so that's my introduction. I hope you found that useful. And now what I'm going to do is I'm going to just take you through the general market update, and then I'm going to then go over that buyer planner with you. So I'm going to show you that the market is also stabilized a little bit here. I'm going to move this video over and kind of start over here. Okay, perfect. So what I always like to do is start with what's on the market right now. And currently, as you can see here, I'm going to move this over here and rock and roll. So we currently have 254 units of inventory on the market. It's right around our 5-year averages again, right? So the market is stabilized. It's found back to its normal amount of inventory for this time of year. We don't have a huge suppression of inventory like we had over the last couple of years, and we don't have a massive excess of inventory where there's way too many sellers and not enough buyers. We're right at the right number right now. And as you can see here, all of our asset classes, singles, semis, towns, and condos, are all right around the normal ranges of our 5-year average as well. And as you can see here, the peak excess of inventory is now being taken out of the market, and we're almost right back to our 5-year average. So essentially that's what's happening in terms of inventory, what the current supply is. And now let's check in on inflow of supply, how much supply is continually come into the market, and then the outflow of that supply. So if we look at the listing inflow, how many units of real estate are hitting the market every day. In September, we ended with 251 units coming to the market, which is approximately 8.4 units of 8.4 homes coming to the market every single day. That is 14% lower than our 5-year average, but it's not that crazy considering we've had a decline in sales. Since we had a decline in sales, this is a very good indicator. You wouldn't want more inventory than this to come to the market. So I think we have the perfect amount of inventory coming to the market right now, considering our conditions. Okay. Next, we have outflow, how many units are being sold. Okay. So right now we have 139 units. And why is it highlighted yellow? Well, I'm just comparing it back to 2017 again, just to show you the difference between the two. This is where the market rebounded here as well. And as you can see here, the unit sales are almost identical from 2017 to 2022. Just an interesting little thing that I wanted to share with you. But in 2022, September now, 139 units sold. So that's 4.6 homes a day that sold, which is approximately 27% lower than where we were typically at. So with 15% less supply coming in the market and 27% less sales, that's why it's a nice balance right now. Not one's going higher than the other. Okay, so we got a healthy amount of supply coming in, and we'd like to see a little bit more outflow happening, but it's a pretty stable outflow still right now. The one that is still an issue is the amount of homes that are failing to sell. So what this just indicates to me is that there's still a lot of sellers out there essentially trying to get a price that's not actually going to happen anymore. They're still living in February and April and March, and they're not living in the new market, which is right now. So I feel like there's a lot of people going up and coming down because we haven't had this many homes fail to sell ever. I mean, you can look back 5 years, 6 years, 7 years. Not ever have we ever had this many homes fail to sell. So we peaked out in June, which is funny enough. June was our peak inflation rate as well. But as you can see, June was a tough month for the real estate market. It corrected. I think it was one of the largest correction months as well. So we had peak inflation, monthly average sold price here in June. We had a 6.7% drop. So yeah, May, June, and July were the biggest hits to the market, which essentially is the 3 biggest months of inflation. Okay, getting back on track here. Just wanted to show that to you. Where was I? So amount of homes failed to sell. As you can see, those 3 months were the biggest months that we had failed to sell. And just like inflation's coming down, so is this. Market stabilizing a little bit. Less homes are failing to sell. More units are actually selling. But still pretty high, 4.2 homes, which is 67% above our 5-year average. And take this with a grain of salt. Yes, it's a shocking number, 300% more than last year. But last year was one of the hottest markets we've ever experienced in history. And yeah, not really anything was failing to sell last year. Okay, great. So now we kind of have a beat on that. And I have a chart that pulls this all together that visually illustrates what's happening in the market. So what's going on with sold days on market? So if you're selling right now, the average days on market for you to sell is 28 days. It's up 1 day from last month. Sold price, list price to sale price ratio. So essentially, if you're listed for $100, you're getting about $95 for that opportunity. So if you go for 100, you're getting about 95, which is almost up, not quite 2%, but it's up a 1.5% almost from August. So again, another signal that the market's U-turning a little bit. And as you can see here with the monthly average sold price, which we already covered, we ended at 784,000, which is up 2.51%. Our first gain since we peaked in April. Pretty cool, right? One thing that I wanted to highlight in the quarterly is that we're pretty much right on track with where we were last year. So I know we had a little bit of a gain in the month over month, but for the third quarter, we essentially are right back to where we were in 2021. So essentially the gains of last year have been evaporated, and I'm going to predict that our Q4 numbers are going to be substantially lower because, as you can see, in 2021, we had an incline in our average sale price as it went, and now we're obviously on a decline, and we're going to have even if the average sale price stays the exact same, it's going to look quarter over quarter pretty bad. But I think we just have to look at what's happening right now and look that the market has stabilized, maybe a little bit up, maybe a little bit down, but I think we're just looking for stability right now. Okay. And I pointed out this as well, some pretty interesting stats here for your information. So in 2022, in that third quarter here, our average sale price was 773, but our unit sales were down substantially. So we sold 32% less real estate in the third quarter than we did last year in the same quarter. So a substantial amount of real estate was not being sold because typically we're selling around 600, 700, it's about 600 units on average that we're selling in the third quarter, and we only sold 383. So quite a bit down in the third quarter, and it's going to be interesting to see what happens in the fourth quarter because as you can see right here in the fourth quarter, year over year in 2021, the average sale price went up 28%. And so it's probably gonna be down significantly because 830 was one of the highest numbers of last year. So we'll see what happens. I'm expecting that we're gonna be probably flat around the $750,000 to $780,000 range by the end of the year. Okay, perfect. Moving on. Let's go inventory flow reports. Yes, so this is kind of showing us what the market looks like in terms of stability. I'm going to zoom out just a touch for you here. So what is the market doing year over year comparatively? So far we've had 2,853 units come into the market. That's represented by the green line. That's how much inventory is becoming into the market. And that's up from last year and our 5-year average. So we have more inflow this year than ever before. And I believe that's because we've had many homes fail to sell. And if a home fails to sell and it recycles the listing, it's essentially driving up, over dramatizing the fail to sell number and over dramatizing the amount of listings we actually had. So I really do feel like we could probably take 500 of these fail to sales and then take 500 away from here because from essentially just listings recycling themselves. But it is what it is. I would take that with a grain of salt. The number that matters most here is how many units have sold. And as you can see, we've only sold 1,600 units this year, which is down 13% from our 5-year average and way down from last year. So because of this inflow and outflow, we've added 271 units back to the market, which is something that we desperately needed here. And I'll explain why right now. So as you can see here, we started January with approximately 69 homes available for sale, significantly lower than our 5-year average. And it just took a long time. This was the story last year. There was just no inventory and inventory couldn't keep up. So there was lack of supply, excess demand, essentially just like everything else in the world, which just drove the prices up. But as you can see here, we finally recovered in May where the inventory levels stabilized to our 5-year average. And then we got a little bit of excess here in August. As you can see, we had inventory above our 5-year and now it's coming back down to our regular levels. So that's the 271 units that have been added. Essentially, it replenished our inventory back to the 5-year averages. So just to give you a little bit of an overview of how much inventory is available on the market. So we have 254 units available right now. And if we take an inflow rate of 7.6 homes a day, in the next 30 days, there should be about 230 units coming to the market. So if you take this plus this, it's going to equal 483 units. So what does that mean? So in the next 30 days, there's going to be 254 units for sale. We're going to add another 230 units. So essentially in the next 30 days, customers are going to have an option of around 483 properties. With that in mind, we're going to probably see an outflow of 250. So this is the outflow of homes selling, which is around probably 4.6. And then it was the failed to sell, which is again around about 4.2. So that, or whatever those numbers were that added up, we'll make 8.3. So failed to sales and home sales combined, we're going to see about 8.3 homes out of the market a day as well, which is about 250 in the next 30 days. So I'm predicting that at the end of this month, we'll be right in line with our 5-year average, and we'll be carrying about 233 units of inventory on the market. And if no new homes came to the market, this is called absorption rate. It's essentially a statistic people use to measure how hot the market is. Essentially, if anything below 2 is usually still into a seller's market, but the reading's a little bit off because our failed to sales are so high. I do believe we're kind of more around the 2.25 mark. So we are in a balanced market right now. So I do feel we're pretty balanced at the current moment. Great. So that's everything that happened there. And again, with a comparison report here, I just want to show you that, yeah, this is usually the time where inventory really falls off the map. So if you are in the market and you're looking for that right home, you're going to have the most options essentially in the next 30 days. With the current inventory that's on the market, with the extra 250 that's about to come to the market, this is the right time to essentially be buying, because after this, inventory is going to be not coming to the market. As you see here, we're not going to get a lot of inventory, and we're going to just have outflow, which is essentially going to take away your options, right? Okay, perfect. So that essentially covers the market. I hope that was very helpful for you. I know there's a lot of information here, and you might not need to know all of this on whether or not you're trying to buy or sell, but your real estate agent should know what's happening in the marketplace, because if they don't, I don't know how they're going to advise you how to potentially position yourself properly, and I'm not sure how they're going to guide you as a buyer to make great decisions. At the end of the day, you're the hero going on your journey, and you need a guide to take you through that journey properly. So that's why the Zon Team Real Estate Advisors, we guarantee that 5-star real estate experience. We have the systems to create 5-star real estate experiences. Plus, we have the knowledge to make sure that you're going to get not only a 5-star experience, but a 5-star result as well, because that's going to be really important as well. Okay, so for the last piece of the puzzle, I know this is a longer video, but here I just want to take you through this buyer planning scenario, and just to kind of show you what the difference is between what happened in April and what happens right now. So for example, let's hypothetically say you have $100,000 to purchase a home. If you have $100,000, and if you were buying back in April, the average sale price was about $1 million. And at this, technically speaking, you couldn't even bring 10% down to the property. You had to bring 20% down. Only anything over $1 million, the minimum down payment is 20%. So I'm just going to put this to $999,999. So that will get us under the threshold of the $1 million. So then you can technically bring 10% to this. Okay. So scenario 2 is today's average sale price. So it's currently at 767. Let me update that to the current numbers. So I'm going to go over here, monthly sale price, and I'm doing this live for you just so you know that I'm doing the numbers properly and you're getting the best information. So I'm going to paste in that number here. There's 784,000, 10% down. Actually, we're not doing 10% down. We are doing 10% down on the million, and we're doing 13% down on your 784. So just right there, you can see that your dollar is going further, and it's going to be important because of the CMHC insurance premium. And I'm going to take you through this. I'm not making these numbers up. These are right from this site right here. And I'm going to show you the math here. So if I have let's go 999,999, we can see that the minimum down payment we can bring is 7.5%. So you actually can put less equity into the property than I've projected here. You can go with 7.5, which is 75,000, but I did the 10% projection here just to keep the numbers the same on both scenarios, okay? So there's your down payment of 100. Your CMHC insurance is going to cost you $27,900. We can go back into our buying calculator, paste that in. I already had that there. And as you can see here, for your $784,000 property, which I'll put in now into the mortgage calculator here, 784,000. Boom. There's your essentially we have $100,000 down. So I'm just going to fix this one to 100. There we go. So your CMHC insurance is $21,204. Okay. Why am I telling you this? Why do you even care? Well, I'll just show you now. Boom. That's your first savings. You just saved $6,696 because the average sale price is lower than what it was back in the first quarter of the year. So just right there, there's your first savings. You're already $6,000 ahead. Okay. Back in April, the interest rates are about 2.85%, and we're doing this scenario on a 5-year term, 25-year amortization. If you don't know what that means, just call us. We'll walk you through it. I'm just showing you that we're keeping the scenarios the same. Okay, so the interest rate, as we saw now for this month, is 4.49%. So I'm going to put that in there for. And actually, as you can see, the last time I did this, it was 4.59. So the mortgage has actually come down 4.49%. There we go. All right. So for the big reveal here, as you can see here, there's our first savings. Now let's see what else we save money on. Land transfer tax. So if we bought $1 million house back in April, the land transfer tax would have been 16 grand versus 12,000. So there's an additional $4,317 that you do not need to bring to closing and that you just put back into your pocket. Additionally, on top of that, CMHC insurance, I'm not sure if you know this, there's HST. And for CMHC, there's only the provincial sales tax portion that you have to pay. So the PST on your CMHC insurance, which was above here, right here, there's your CMHC insurance. That comes in at $2,232 versus the $1,696. So another $535 you're putting into your pocket. Okay. So your one-time closing costs are actually down almost $5,000. You just saved $5,000 in closing costs. Okay. How about mortgage payment? So mortgage payment in scenario one at a 2.85% interest rate, which is an amazing interest rate, no doubt. $4,320 if you would have bought back in April. Right now, if you're buying at the 4.49%, your mortgage payment is $3,899. Okay, so I've made sure that the property taxes, home insurance, and the heat was all the same in the scenario because essentially it's the same house, right? It's just the average sale price went down. So your monthly commitment is $420 less per month than it would have been back in the first quarter. So what does that mean? Well, one-time savings costs. So your one-time saving costs include your down payment and your CMHC insurance savings. So right there, your one-time savings is $11,000. Your total monthly payment annualized is $5,000 per year, right? Because you're going to save $500 a month every single month, and you sign up for a 5-year mortgage term. So it's $5,000 a year or $25,000 over the term of your mortgage. I'll put it all together. You're saving about $36,000 buying now versus buying in the first quarter of the year. $36,000. That's a lot of money, in my opinion. That's quite a bit. Maybe that's not for you, but for most people, I think $36,000 is a significant savings, and it's a lower monthly payment as well. So a lot of things are going right in terms of buying, and if the market has truly bottomed, and it's going to start inching back up, you're also going to get the appreciation of that property in terms of obviously equity growth as well, right? So that's not even equated into this math. So let's say, for example, the market worst case scenario drops another, what do we say, another 5%. So if I go into this area here, I'm just going to do it right here, equals this times points, where's my times 0.05%. So another $30,000. So if the market dropped 5%, it would go down $39,000. That doesn't even wipe out the savings you did. and then the market is going to be going up. If the market's going to go up 2%, for example, every single year, if we're going like this, and let's say the market goes up 2% from now till next year, another $15,000 in equity growth, which then you can add on top of the 36,000. So you're looking at about 50 grand if the market goes up only 2%. And I'm just going to show you something real quick. I know this is getting longer, but I wanted to show you this. I'm just going to delete this out. When has the market gone down? And what is the typical rate increase in equity? So let me just go to my year over year to show you. Okay, here we go. Let's go to the annual. Okay. So in 2015, the average sale price, the market went up 6.61, 13% in 2016, 20% in 2017. Here you go, a 0.06% decline in 2018, not 5%, 0.06%. Then we had a 6% growth, 15% growth, 24% growth, and we're still on a path to be up 18% this year. So why am I telling you all this? Well, I projected a 2% growth for you from buying after the market peaked. So anyways, I hope this information was really helpful for you. Obviously, we walk all of our clients through a buying planner. If you're selling, all that fun stuff, away you go. So I just want to show you the last summary payment here. So essentially, this is the high level overview. You brought 100 grand down. There's your purchase price. There's your down payment, one-time closing costs, your monthly obligation. So essentially, to buy these houses, you would need an additional $22,000 to close this one and $17,000 to close this one. So essentially, you need $118,000 to make scenario 2 happen, which is the scenario right now. So if you're looking to buy again in the market, give us a call. We'll definitely help you out. So if you have any questions, please feel free to reach out to Zon team, and I'm looking forward to hearing from you soon. Thanks. Bye.